One more time for TiE Seattle. Thank you so much. Super excited to be here today. We've got an incredible group of panelists. We've got a farmer and a founder, a published musician, a former UW Husky football player, and a former college tennis captain, on top of so much startup, VC, big tech experience. So this is quite the talented panel we have. Super excited to hear all the insights that we'll hear today. I figure we just start with the topic on a lot of people's minds, which is the economy and a recession, or the so-called recession, and how that's affecting tech investing, VC, startups. So I guess my first question is, are we in a recession? And then we can kind of get into how the conversation, the economy, the narratives are impacting your jobs and your portfolio companies. So, all right, I'll give it back to you.
Okay. I guess starting that off, I think there was, I don't want to steal from James, but I will steal, which I think it was you that said, if everyone thinks we're in a recession, we're in a recession. But look, like the data anecdotally is not good. Like, obviously you see what's happening in the macro. The majority of companies I invest in are B2B software companies, and there was an initial wave of sales cycles slowing. Then there was maybe we're ready to buy software again. And others like, no, maybe we're not again because we have pending layoffs. Like, I think you should be shocked if you don't see a whole other wave that I guess we're already starting to see, but I expect them to happen over the next few quarters. And I think ultimately what we're looking at is that we are in a recession, and that is okay. But I think the sooner that people just accept that that's where we are and start budgeting and planning accordingly, that's correct. And so therefore it doesn't matter if we're in a recession or not, because I just told you that we are in a recession. And so therefore everyone I'm talking to thinks we're in a recession, and therefore we're in a recession.
I don't even know how to follow that up. Similar to Aviel, I invest at the early stage, and so I guess what I'll share is what we're doing differently, and I think we can talk more about this later. But I don't like to pontificate about recession or no recession, but I will say, talking with a lot of our startups and working together on what is the plan going to be for the year ahead versus what was the plan over the past couple years, it's just a very different conversation, very different tenor, very different way that we're thinking about the economics of a business and how do you get to a certain level, that's acceptable either for doing your next round of fundraising or getting to cash flow positive. So it just feels very different at the early stage. And I think we potentially are the most insulated to a certain extent because we're dealing with companies that are baby companies, just ideas, just getting started. You're building your product for the next 12 months, so maybe you won't even need to sell until 2024. So you have some sort of if you're starting a company now, you may have some sort of insulation to just be head down and building. But for our companies that are selling, it feels a little different right now. And I don't think that will change, at least for the rest of this year, for budgeting at the very least.
I think I can shout. Can people hear? So we don't have to pass mics back and forth. I think that I would just underline the word different. It just feels different, but that doesn't mean that we're in a recession. Like, a recession has a technical definition, and I'm going to try to insulate myself from Aviel's negativity and not declare that we are in a recession, but that possibility exists, particularly as that contagion catches on. But it feels different, but that's not that bad because 2021 was the aberration. And we had one of my companies was performing really well. They had a decision point. Do we want to raise now? Do we want to raise later? They controlled their own destiny because they built a really great business. And one of the founders kind of made a flippant comment like, let's just wait a few months till the market comes back. And it was like, whoa, guys, that market is never coming back. I'm 41 years old. I want to catch one more bubble. Like just one. That's all I need before I actually retire. Like we're just never going to see that again, hopefully, unless Powell does something really, really wild that I don't expect to see.
Yeah, and I think my answer is maybe a blend of James and what everyone has said, but no, I agree. I studied human geography in college, which is essentially demographics and human behavior, so I'm not an expert macroeconomist here, but I think looking at the numbers, it's certainly not great in our economy, but look at inflation, it's high, coming down, but not at 2%. But if you look at the stock market, I mean, the Dow is down, I think, 5% from its high to your high in January about a year ago. And so, to James's point, like it's different. But what I think will certainly thrust us for sure into a recession is, of course, if the Fed continues to raise rates. But
Which they will.
Yeah, which they will.
Yeah.
And to the comment that Aviel made, where you have to lean into this aversion, this risk aversion, this psychology, and we're talking about this recession, and of course that's going to affect your psychology as a consumer, investor, etc. So companies may slash capex more than they should, or make more layoffs than they should, or spend less than they should to drive appropriate growth. And I think the truth of the matter right now is capital is expensive, talent, debt, equity. I mean, gosh, in housing and mortgage businesses, rates are high. We know that for a fact. And all those components, that affects your psychology overall. So I think to Aviel's point, like we can certainly will ourselves and thrust ourselves into it that way as well.
And like, is it like the economy in recession, or like for damn sure the startup world is in recession on all these points, which is like, there's no soft landing, because what the hell were we doing for a little bit like that? There's no way to softly land that. So I'll just leave it at that.
Yeah. Okay. So some numbers from CB Insights. So 2022 U.S. venture total raise was $198 billion. That was down 37% from 2021, but it was up 31% compared to 2020. So to your point of 21 being an outlier, like what were we doing, I guess. But given where we're at now, whether your opinion on if we're in a recession or what's going on in the economy, how are you assessing investments differently, whether it's your existing portfolio companies or new entrepreneurs who come into Madrona or Voyager and they're pitching you? Is your mindset different in January 23 than in the past?
I'll kick it off. I think there's a lot of ways to answer this. On the one hand, we think about investment pace. I think we could all agree that because of what happened in 2021, the investment pace was really fast. There was a lot of companies coming to market. Valuations were sky high. I think from our seats as investors, a lot of the deals were very competitive for a number of reasons, so we moved really quickly. Now that things have become a bit more normal, and granted, I've only been an investor for 4+ years, so my experience has been the market going aggressively in this direction, right? It has changed a little bit. I think our approach to investing is to maintain a normal clip. So we still plan to invest as much as we ever did. We just raised a new set of funds that we opened up a few months ago. So we're a multi-stage fund, seed, Series A, Series B, and a little bit of Series C. And we just opened up $690 million in funds a few months ago to lead and participate across all of those rounds. And so our intention is to actively invest out of those set of funds for the next few years, which is our normal cadence. I think what's interesting right now is at the very earliest stages, and I'd love to hear your take on this and yours as well, Sarah, is at the very earliest stages, things can still move fast. There's still incredibly compelling entrepreneurs starting businesses today that, to my point earlier, they won't really need to sell or have any meaningful revenue traction until a couple years out. it's the companies that are raising their Series A, their Series B, and their Series C, where it is challenging because they have some traction, they've already demonstrated product market fit, and yet now they're experiencing the first kind of sales headwinds they've had, and they're trying to recalibrate. What does growth mean for our business? What is happening to all of our customers? Do we have, this right mix, and how do we de-risk kind of our customer base? So there's so many angles. I'll pause there. Who's next?
I mean, I can just say something provocative, which is like how we've changed is we've narrowed our aperture into where we've historically had the deepest understanding in the types of businesses that we've invested in. I mean, for us specifically, that's looked like more investments in vertical SaaS and other areas like that, whereas over the past few years, we would just look at amazing founders with amazing fundraising abilities and just be like, fuck yeah. Like, we're going to learn a ton. They're definitely going to raise more money. Why would we not be part of this? And you know what? We were rewarded for that. But we also very quickly realized things are changing and you can't keep operating that same way. So when I think about what we're going to do differently, it's that, which is is this a business that we understand how they can build a business without being completely reliable on both the capital markets and very, very dumb money? Because you know what, like the only thing that all of our successful portfolio companies have in common is that none of them have run out of money yet. They've all had very wildly different journeys. And we just went through a period where like you had to suck to run out of money. And there were certain ideas and certain things where you would just be like, let's lean into this because this is going to work out because of that influx of capital. And that has changed overnight. And so it's like you better understand what you're doing.
Well, I think, from our perspective, and I was just thinking about this, even what we communicated to our LPs, our investors, and obviously there was a lot of slashes across seed, early stage and mega and late stage. But, one thing that didn't change and where I think we're still finding our conviction is the amount that enterprises are investing in SaaS. I think there's a stat that cloud software spend across the enterprise increased, I think, 18% from 2021 to 2022, and it's still expected to grow. It's supposed to grow 21% in 2023 to $600 billion. And so, what we've really summarized that to be is, enterprises still know that productivity is one of the best ways to ensure, positive outcomes in times of economic uncertainty. And I know Satya Nadella, you quoted saying that, software is the best deflationary force for businesses. And so, I think for us that just tethers us to our B2B software conviction and leaning into that. Whereas, our aperture was broad, and we certainly look at a lot of businesses with digital components, but it's just really brought us back into that focus as B2B software can really help with productivity and help with cost structure for businesses. So I think you'll, of course, see volatility in lots of different asset classes and different VC investments, but hopefully we'll see some recession resistance with B2B software.
Well, if you're looking for 4 answers to every question, I'll say something as well. I think the expectations have changed in every conversation when a founder comes in, and it just takes some time for a valuation reset to just be digested in the ecosystem. And guess what? As it turns out, the 4 people on this panel digest valuations lowering really quickly. So we're really responsive to, public market comps are down. Well, we better reset all of our valuation marks. And unsurprisingly, founders are much less quick to come to that same conclusion. And so you end up with a period where it's hard to match expectations, that the bargaining zone between parties ends up spreading out. And so only the companies that we see most often are the ones that must raise, which are, of course, the ones we don't want to back. And so you have a bunch of VCs complaining about, I'm seeing a bunch of nothing. These companies suck. And the good founders put their heads down. They have raised enough runway, or maybe they raised 2 rounds instead of 1 from Insight. And they're going to need to hit, really, really high benchmarks to get, through the Series B, C, and into the growth stages. And they've got a hard road ahead of them, but at least they've raised enough capital to kind of get there. And then, deal volume, which I expect to this year, picks up as you end up with essentially clean cap tables coming through, ones that don't have those same kind of scars. And so there'll be a reasonably painful period where good businesses or businesses that can make themselves healthy can reset things, grow into their prior valuations, or reset the cap tables if and when needed, and make sure that we can flush out some of the excesses that we saw during that longest bull market period in our country's history, followed by 3 months of weird pandemic freezing and then insanity.
On that point, with the existing portfolio companies, take us into those conversations you're having with them as we look at 23, and I think we'll get into the layoffs. Obviously, we've been all experiencing in one way or another the layoffs are happening across tech, across big tech startups. But what is the advice you are telling founders right now? And it depends, I'm sure, on the sector, size, stage. But with the existing companies in your portfolio, what are you telling them?
I can start with a quick thought, which is the thing we shared, and it can be hard. Thankfully, I'm comfortable being uncomfortably honest, is that you look like shit right now. What has just happened is that you feel like you have moved forward, but the whole world pulled you all the way back. So where you thought you were and how you're going to be rewarded for it is great. But we all know the second that you feel like you've accomplished something, even if you haven't accomplished it, it feels like a loss when that's taken away. So it's literally like bringing founders through this grief process as quickly as possible, of saying these things that you thought you had, you didn't. Wake the fuck up, or you're going to die. And your next bar, like the things that we're celebrating right now, are congratulations, you raised a flat round, and we have a chance. That's what this shit looks like.
I'll add a little bit of color riffing off of what you just said about resetting a capitalization table, which is a difficult thing to do. It's when, certain investors kind of get crammed down, or, founders are diluted because all of a sudden when you raise new capital, the terms that you're raising that new capital on are worse than the previous round that you raised. And so there has to be a give and take. And I think what you're referring to in this weird kind of come down period is that over the past year especially, a lot of the capital was kind of cheap, right? And the we'll grow into our valuation was a tomorrow problem. But that was happening for so long. Startups had to raise money. You raised what you could get. You raised as much as you could get to extend your runway. And now we're in that period where you have to face the music, because capital is a lot more difficult to come by. It is not as cheap as it used to be. And if you can't actually deliver on core metrics inside your business, on some of the growth or profitability, get to cash flow positive, whatever the new goals are, it's going to be very difficult. And the next round of investors coming in, to what James pointed out, they're looking for, hey, you're raising capital. I have some, but we have to be able to figure out between our different sets of expectations, how do we get a deal done? And we are still in this middle period of where does that settle out? When does the economy turn back around? Versus how much runway does a startup have? And usually that's a very tight time period for when a company needs to fundraise.
We can go around it. We can do all four if you want.
Let's keep it moving.
Okay. Yeah. Well, I was going to switch gears a little bit to investments that you're excited about to make this a little more positive. And a topic that is everyone's favorite subject right now, ChatGPT. And more broadly, generative AI. I'm sure we've all seen some of these tools, and frankly, some of them are pretty incredible in terms of what they can do very quickly. Quick hot takes on generative AI, ChatGPT. Have you made any investments in this field? And where are you seeing opportunities, if any, with this technology and startups taking advantage of it?
Yeah, we did. We actually did a very early bet in this space, actually along with our friends at Fuse, in a company called Well Said Labs, which does synthetic human speech. And so it's really, really mind-blowing stuff that, you can go on there. I send people messages as Wade. He's my favorite voice, much better voice than mine. Yeah, he's the best. And so this is, really replacing anything that you would hire a voice actor to do. So they, their initial sort of wedge within what they would have called their product market fit was within content creation for, I think more for corporate use cases versus like commercial reads. But there's, thousands and thousands of people out there who are, generating KYC videos at banks that we all had to watch, you actually have to watch those. And somebody literally has to, to provide a voiceover of that so that it's much less painful. And so doing that automagically instead of hiring a voice actor doing a bunch of script edits has been just a fascinating use case. And they're really, really pushing the technology beyond what anybody else is doing. And that's a homegrown company here that was actually started at the Allen Institute for Artificial Intelligence.
And I'd love to hear what, because I know Madrona's done a couple early.
No, we've made a number of investments. I think just to start with ChatGPT, all of us, we're very excited and kind of been immersed in what are generative capabilities and how do you either get excited about that for a brand new formation stage company, or how do you add some of that into an existing company to create a higher value for your customers. So we've been steeped in this, for the past few months at least. But one of the things that I think is exciting is ChatGPT and kind of these exciting generative capabilities are hitting, the front page for everyone who's not just in tech. One of my favorites, I think, was it today or yesterday, The Onion posted a headline that said, ChatGPT, was needed to take the bar, but it wanted to be an art major instead, or something like that, And it's funny, but one of my colleagues made the point that what we're doing now is we're associating, AI with having regret and kind of this whole bigger awareness of ChatGPT. And, the next step is like SNL doing a skit on it, which I don't know if they have yet, but they're probably working on it as we speak, right? So it is really exciting. We've made a few different investments so far. One I'm excited about is called Runway ML. They're making kind of generative video and doing a kind of generative creative suite, taking on what Adobe has been working on, where you can simply type in phrases to do video editing, and it feels magical. And what does that mean for someone who used to use Photoshop or used to use different elements of the, Creative Cloud, where you can now just write in prompts to take away a background or highlight a certain, moving object or person and do different things to that object. One other thing I think is really interesting, they're doing coming up here the very first AI, I'm going to butcher this, AI Video Awards, generative AI video that's coming up. So, there's a lot of really interesting, easy things you can do to play around with this tech that truly feels magical. So if you haven't tried ChatGPT, just Google it, go to the page, and write in something interesting and just play around with what the responses are. But don't do it on Sunday nights, because that's when all of the students are making their homework.
Yes, that's true.
And to maybe a slightly different sort of angle on that perspective, I think it's obviously some amazingly interesting technology. It feels like suddenly like AI is in the mainstream, like in a way that isn't like a weird robot that's going to kill you. But the way that I've looked at it is look, there's the companies that are going to be the ones who are building the models themselves, and that's super expensive. There's companies who are going to be, sort of the glue helping people use the models, and there's going to be the companies who are then implementing the models themselves. Most of what we've seen implementing them into existing products and workflows, and that's the majority of what we've seen in portfolio is folks being like, we can layer this into the workflow in the same way that maybe we were thinking about, like RPA before, like process automation and things like that. But I think we're in this very interesting moment where if you go back in time to the rise of SaaS companies, which are like functionally just, we built a business on top of CRUD calls to a relational database. What you didn't want to be is you didn't want to be the company who's like, we're going to invent the database, we're going to invent the software on top of the database, and we're going to figure out how to provide value to customers. And I think right now we're in this tricky moment where if you're the company who's just building the database, there aren't enough people making money to pay you. Thankfully, Microsoft is funding OpenAI, so we're all good on that. There's not enough people who are actually implementing it, so if you're in that middle layer, it's unclear that a business can be built. And so right now it's great to be those people who are doing on the top, but at the end of the day, what's your moat, what's your defensibility? Why is somebody not going to do this just better than you because you're just implementing ChatGPT or something else? And so I think it is this amazing gold rush that may also be a fool's errand from a VC perspective, because I right now look at all this and say, which of these buckets do you fit into? I'm kind of terrified of all of them. So let's see what happens.
Other sectors you all are excited about? If you were tomorrow you're not a VC, you're a founder, what area, what industry are you going into and why?
Farming.
The quick answer is I think there's so much outside of enterprise software, which is where I spend all of my time. I think climate tech is incredibly exciting at the moment. I also think, one side of our investment thesis, we call it intersections of innovation, where data science meets life sciences. There's a lot of opportunity right there. So I think those two categories especially, I would look into.
I would actually, that would be my answer as well. The second one around life sciences. I don't do anything around life sciences, but every single time I see somebody pitch a life science idea, I just want to hand them my wallet. Like, you're gonna cure cancer? Awesome. And I would be dumb money in that space, so I don't invest in it. But if I was going to do something else and take a totally different path for my life, I think that'd be a fascinating place.
Yeah, I agree with that. That would be super cool. And I think, my answer, I just, vertical SaaS, which is very broad, very, very broad. But, I think specifically within that, I'm just super excited by businesses that are empowering what I think of as just people on the front edge. So, two examples in our portfolio are a company called Zuper, which empowers field service workers, and then one called Zemelgo that helps with industry and factory automation. And so I just think it's so fascinating to find industries like that just have these processes that are super mission critical, but how can we help with that? So broad answer, but just think it's fun to learn about every day and go to school in a new industry.
So we've got entrepreneurs here, or perhaps folks that want to be entrepreneurs, or maybe one day. Is this a good time to start a company? And I guess you could answer that and say it's always a good time, but in these conditions, with the economy, with where the industry is at, with where VC is at, is this a good time to start a company, or would you advise? What's your advice to people who want to get in the game, but maybe you're trying to figure it out?
I'll put my founder hat on. I started my career as a software engineer working for founder Kabir Shahani, who was there's no reason for him to hire me. It was wonderful to work there in 2008. And then started my company functionally raised in 2009, so it was sort of the crash and then right after it. And it was a terrible way to make money. I remember my uncle being like, "Are you insane? What are you doing? There's so many different things that you could be doing." And for me, it was like, I can't stop myself from doing this. I have a hole inside of me. I am broken. And the good news is, if that's you, this is the best time ever to start a company, because everybody else is going to be like, fuck that shit, that looks impossible and hard. Because, the reality is, right, I was having conversations with founders who were like, I don't know what I'll really do, but I'll raise this round and I'll take $5 million off the table at the B and I'll do this and whatever, and I'll buy that house and do it. And I'm just like, what is happening? So right now, a lot of that noise, those tourists, those people that were here for the glory, that noise is gone. And the problem was, you were really competing with those people because a lot of them were charismatic. They were great fundraisers. They were going to wreck your market because you were going to do something that was going to work. Instead, they were going to raise $100 million and screw it up for fucking everyone. And now we're in a spot where those people just won't be there because those strategies don't work. So I would say right now is just as terrible of a time to have the, whatever childhood trauma or other issue that makes you want to be an entrepreneur, and probably the best. But, okay, I'm just going to stop and I'll hand this off.
I saw someone post the other day about the Google layoffs, the large-scale layoffs that happened like a week ago, very recently. And it was someone, galvanizing the community, saying, hey, all of us who have gotten laid off, we should get together and found companies. We should take, our severance and use this opportunity to found companies. And I think there's two ways to think about that. One is it's exciting. If you have been thinking about tinkering, and this is, that moment where you're finally going to have a little bit extra time to do that, great. However, the best founders are ones, to your point, that really love company building, and they can't not build this company. And so just because you got laid off, or just because some other life event happened, shouldn't, is that really the reason you want to start a company right now? Are you passionate enough, and had you not been laid off, that you would have done this anyway? And so I think some self-examination around, is this really the right time for you? Is this the right time for the idea that you're building? That the conviction that you have internally that you are ready to go for this 100% is incredibly important. So, I kind of, I am excited for those who are dedicated and excited to, find a co-founder and recruit a co-founder to join them, to be able to hire your first employees. You have to be dedicated, right? Like, this is the long haul. And so falling into entrepreneurship through convenience, I think, is a trap you should stay very far away from.
There's very little I can add to that. I don't think it's the right question to ask. I think you're probably already going to lose if you're asking, oh, should I start it now or should I wait for the market to improve? It's like, hey, when's the right time to buy a house? Well, we're ready to buy a house, or we're ready to have kids. And if your idea is of the moment and you feel committed to it and convicted around it, as she said, I think that those are the right questions to ask, not trying to time up, whether you can get a seed check out of Madrona.
Mm-hmm. Yeah, I think everything I was going to say is, in summary of that, it reminds me, I remember when I was thinking about pursuing music full-time a handful of years ago, this one guy I was working with, he's like, do you like anything else? Like anything else? And he's like, if you do, please go do that. And I just think about that to Aviel and Elisa's comments, where it's like, I think you know thyself and the conviction that you have, and I think, recession or not, innovation never stops. And so, the founders that are going to go out right now, it's just going to be this whole new level of grit and resilience and determination and, discipline around cash management and things like that. So, I think there's optimism if you go and do it at the opportunity ahead. And frankly, like all companies should be focusing on having that discipline. But otherwise, retweet to what all you said.
And how about folks on the other side of the table? And I know there might be people here who have built up some cash. They might be ready to invest, either become an angel, go the VC route, join TiE Seattle Angels Network, which I know launched just a bit ago, a really cool program. What advice do you have for them? Is this a good time to start investing, to join an angel network, to become an angel? One knock on the Seattle region is we don't have enough angels. So what would you advise fellow investors as they look at this market and maybe this region and say, I want to back some startups?
I would love to take this one. I think this is a great time, or at least becoming a great time. Because right now, we're making fun of, we're talking about how hard it is for startups and how, screwed up their valuations are, and you're probably all looking at us and you're like, but you did this. It's like the guy, the hot dog guy, when the Wienermobile drives into the store and he's like, I'm looking for the guy that did this. And you're like, you guys obviously did this. The reality is you have to play the game, because otherwise someone else is going to beat you at the game, and that's what the game is today. And right now we're in the moment where the game is changing. And I think that's always an amazing time to enter, and that is certainly what's happening in our industry. I don't necessarily think that a lot of the early stage valuations have corrected to the place that they should. I'm now at least once again seeing, $6 million post-money valuations, not just 10, not just 15, not just 20. We passed on Twilio because a $4 million valuation was too high. Okay? So we're not there yet, but it's a great time to start for the reasons I said.
Can we just duck a few bullets up here, though, that these are Seattle VCs, and like it's just worth clarifying that when you talk about drunken excesses of the venture industry, that like that phenomenon was really centered on the Bay Area, was New York, LA. Just to clarify, things were a lot worse there than they were here. As any founder will tell you, it's always been harder to raise here. VCs have always been more valuation conscious. So yeah, I mean, we saw things go up if you look at the data in this ecosystem as well, but not to the same extent that was happening down there.
To that point, I think this group is interesting in terms of the broader VC community here in Seattle. I mean, I would call you all kind of the new guard of VC Seattle, based on just how long you've been at your respective firms and based on some of the other folks that have been there a lot longer. Can you talk a bit about that? And do you bring something to the table because you're either younger or you're newer to the industry versus some of the veterans? And is there even that dynamic? Am I just trying to create a narrative for a GeekWire story? I do think it is interesting because we've had, looking at the Seattle ecosystem and how it's grown over the past couple of decades, there's obviously long-standing firms who have been here for a long time, Madrona, of course. Whereas Fuse just started a couple years ago. So it's a really interesting time in this ecosystem looking at who's been here for a long time and who hasn't. Just curious if there is any of that dynamic working with some of the investors that have been there for a long time or who haven't, and if there's any type of interactions there or dynamics.
Succession within venture firms is really, really, really challenging, and you see countless firms blow up because they stub their toe in managing a situation often where there's a separation between activity level and economics, and that's been true for basically since the beginning of the industry. And if you trace the lineage of a bunch of firms down in the Bay Area, you can actually see how that happens. In the best of times, you have really great leaders who hand the reins over and allow a firm to blend the new with the old, new relationships, new experiences. And speaking only for me, it's been really helpful. I have one of the founders of Voyager still actively involved, Bill McAleer, who probably a bunch of you guys have met over the years. And he's seen a bunch of stuff that I haven't seen. I've actually been investing a reasonably long time, and yet, I started in 2009, and guess what? I've never seen a recession either. I mean, think about that. Like, you have to be pretty deep into your 40s to have lived through a recession as an investor. And if you think about like the bell curve of this industry, in terms of there's just the people that are employed as professional investors. Not that many who actually lived through the global financial crisis, and an even smaller number of people lived through the bubble, the internet bubble. Because a lot of people who lived through the internet bubble made a lot of money in the internet bubble and then decided, you know what I don't want to do? Work anymore. And so a lot of that experience got flushed out of the industry. So if you have that DNA within the firm, it can be really, really valuable, particularly as the economic climate shifts. It helps to have people who've actually seen that. Who's seen that story play out.
I mean, I'll add, I think part of the core of your question is how do you think about differentiating yourself as a younger VC or as a newer VC? I think one of the great ways to frame it is how do you bring something to the table that the rest of your team doesn't? And so being very honest with yourself about what's your superpower. And maybe you have several, but which one are you playing up at different moments in your career through different investment themes or different waves that are happening, the Web3 of yesteryear, the AI and generative capabilities of today? And how do you think about building some sort of enduring reputation for yourself from the get-go is really critical.
Yeah. So for those of you that are familiar with Fuse, happy to the quick backstory. So we spun out of Ignition Partners, which I'm sure all of you are familiar with. And what's really neat about the opportunity at Fuse is we're in our fund 2. So a lot of this we've been building ourselves, right? We're being entrepreneurial in our own way too, and learning how to set the culture. But to James' comment, there's so much power in having both sides of perspectives, right? Around, I think younger VCs. I've been at this for 2 years, so still obviously have lots to learn. But I think you bring new networks, new perspectives, new lived experiences based off of your generation that can all contribute to the way that you can, view an opportunity or a business or make suggestions there. But I think there's so much value in having that wisdom and gray hair at the table, so to speak. So it's been really awesome to work with amazing experienced individuals like Soper, shout out, who's in the audience, and John Connors, who's an operating partner as well. So I think the balance is really beautiful and important, but I think there's a lot that younger generations can offer too, while still being really open. And I think openness is a big piece of it too. Open to learning and having new approaches for how to, build relationships with founders. So I think that there's a lot to offer there. And I had another thought, but I forgot. But
And I'm just going to keep it short and sweet, which is that my partner Chris is 15 years older than me. I, as a founder, cut my teeth pitching the Madrona partnership and was this close to being in an EIR at Madrona, and I've learned so much from those folks. And I think the one thing is like what you can bring to the table is I haven't made this mistake yet. And what's amazing about the world that we're in is, timing matters. And so the value is that just having the confidence to be like, this is dumb, but we're gonna have this conversation anyway, because maybe there's something that bit you that is keeping your mind closed to why this would work now. And with that comes being okay with being wrong and dumb a lot, because what you usually hear is like, here's why this is terrible and we would never invest in that. And you're like, fuck, you're right.
How are we doing on time? Okay, and we'll have some time for Q&A, so if you have questions, get those ready. I just want to talk a little bit about Seattle and the ecosystem here, kind of building on this. And James, I liked how you framed the differences in venture capital activity in the different cities. It is pretty stark. In 2022, $7.8 billion was raised here across 479 deals. That compares to Boston, which had $21 billion, LA $23 billion, and of course the Bay Area is an anomaly, but they had $75 billion. And the common knock has been, well, Seattle, given we have Microsoft and Amazon and quite a few other big companies and a lot of startups, there's a lack of money here? We need more VCs. But maybe that's a good thing. I don't know. Do you think we need more investors here? Do we need more capital here? That may have changed over the pandemic with this hybrid work. You can raise anywhere. You can raise over Zoom. Does it even matter where companies are and where investors are? Is part of the question. And two, could Seattle use more capital? And if not, does Seattle need more of anything?
I don't want to take this first.
I have a strong perspective here, but you're welcome to discount this because you're going to say, oh, he's talking his own book. I don't think that we need more VCs up here because you could reasonably cover the later stages of the venture growth cycle from the Bay Area. It's like an hour and 45 minutes. It's pretty easy to get up here. The issue is their funds are so large that nobody wants to write smaller early stage checks and get on a plane. So you can get a $3 million set it and forget it check, but we see companies just get orphaned. That somebody wrote them a $3 million check, they were the lead. Maybe they even have a nice brand in the Bay Area, but that company doesn't receive any time, love, and attention until it declares itself a winner that's going to be impactful on a very large fund. And it's a bummer because, again, it breaks the cap table. And once a company loses momentum, it becomes much more challenging to grow it into something that is interesting. So I don't think we need more Series A, Series B firms necessarily. What we need is more angel investors. We need more low conviction check writers who can, sit in a coffee shop and go, I like you. All right, I'm in for 50. And that profile, which is so common in the Bay Area, is really actually pretty rare up here. There's tons and tons and tons of money, but a lot of people made money at Microsoft and Amazon as employees. And so there isn't pattern recognition of what an early stage company looks like in hypergrowth. There isn't, I think, an innate desire to like pay back into an ecosystem that created your wealth. And frankly, I think we have some Scandinavian pearl clutching mentality around like, oh, I would never talk about my money. And so there's no status attached to angel investing in the same way that when you go, to a party in the Bay Area and someone will give you their angel portfolio and you're like, I haven't even caught your name. Like, who are you? Congratulations on your investment, but like, I don't know who you are.
Uber McRobinhood.
Yes. Yeah. So it's just, we have a very, very different mentality up here, and I would love for people to like lean into the angel ecosystem versus creating a clone of Madrona and massively adding to the LP dollars that are here. We don't really need that. What we need is more, people who care about this ecosystem and want to see it grow.
I'll add that the pandemic made fundraising via Zoom a lot easier, right? I don't know about you guys, but almost all of my first and even second meetings happen on Zoom now. Even if it's in Seattle, right? You have a 30-minute Zoom call, and then you move to kind of face-to-face or a coffee or a meeting after that. You can do the same thing with investors in New York, investors in the Bay Area. There's no barrier there. I think the point that maybe both of you are making is, how do you find the right investor, the right fund that you believe is going to back you, that you feel a connection with, that, if they're making a large check, if they're cutting a large check, they're probably taking a board seat, right? So you're forming a board relationship with this investor and their fund behind them. And is it someone you really want to work with through the growth of your company? My perspective is I don't think there's enough capital, and one of the reasons I feel comfortable saying that is, as an entrepreneur, you should talk to as many. If I were an entrepreneur, I would talk to as many funds as possible. You want to raise the money on the timeline that you want to raise it. You want to find a great partner that you believe in, that has a thesis that backs your whatever area you're building in, and you want to get on with it, right? You want to finish fundraising and get on with building your company. From our perspective, in competitive deals, we feel comfortable competing because we want to show the founders that we really want to work with, here is how we can help you the absolute most. Here's how we put the power of our network, which is a benefit because we are a large and established fund. What are the things that we can do that other smaller or younger funds can't? And so there's an element of that at play too, and it kind of, there's some gamesmanship with other funds when it's a competitive deal. But from a founder perspective, I don't ever think you should restrict yourself to a certain geography when you're raising. I would focus on who are investors who thematically look at the area that you're building your company in. How do you get intel from either a community like TiE or other founders you may know on who are the good investors to reach out to, who are the ones you should avoid at all costs, and talk to as many people as possible. To your point around sharing your angel portfolio, as an entrepreneur, you should be telling everyone your idea and getting connections and referrals and suggestions on who you should talk to next, so that you can get on to moving and building your company.
Anything to add?
Yeah, the only point I'll add, just on what both of these, those are awesome comments. I think the one thing I just think about at the end of the day, your investor relationship is a relationship, and it's a long one. I think the stat's a depressing stat, but your relationship with your investor can last sometimes longer than the average U.S. marriage, which is a depressing stat, twice as long, yeah. So I think, the point, I absolutely go out and hyperconnect, but it's also really important that, when good times happen, you want to call that investor, and when the hard times happen, which they will, maybe it really matters to have that person be a person that you can go get coffee with and be able to sit face to face with. So that's just the only other consideration.
Yeah, on the point of face-to-face versus Zoom, remote work, another topic we all like talking about right now. Based on your experience working with portfolio companies and what you're seeing, are there policies that you're seeing that are working well, or do you have another hot take on we all need to get back to the office, or hey, remote is fine?
Yes. I mean, first off, I'll say I love remote work. I'm wearing my farm boots, so that's only possible because of that. But look, like, I feel like there has been, over the past 10 years, and I experienced the start of this when we were running Simply Measured, was this sort of convergence and watering down of startup culture to be like, this is just what a startup looks like. Like everything from the ping pong table to, I don't even want to say all the things that has changed over time, but I think the most important thing that was always there was feedback from people about how they wanted to work, where they wanted to work, when they wanted to work. But there was just this feeling of like, we somehow have to make this all work for everybody, and it never, like, it was always a shit show. That was always the issue in HR. There was always issues of like the engineering manager, like, my job's fucking impossible. Like, we can't lose it. Everyone wants to work differently. What do I do? I think now there's an opportunity for companies to say, this is how we work and this is what we do. Does this culture work for you? And again, it's not about a ping pong table. It's not about, a keg. It's not about that. It's like, this is who we are and this is how we work. And I think that's what's exciting, is you can actually create an authentic culture because of this mixture of in-person, remote, hybrid, and find like what works for me in my life and the way that I want to spend time with my family, my hobbies, my interests, and what do I want. I think there's nothing wrong with somebody that wants to work in an office 120 hours a week, and there's nothing wrong with someone that says, I never want to step into an office and I just want to work 40 hours. I think the thing that's wrong is when you try to make those people work together. And I'm super excited for how this is panning out, and we're starting to see portfolio companies be opinionated about this is how we're going to work. And because we're early and not, giant companies like the Coinbases of the world and others who like throw down this gauntlet way too awkwardly late, which is problematic. Like, you can set this early, and I think this is a really fun thing. We also work with companies we fund recently about how do you want to build your company and how do you want to think about this, and this will be a major driver of your culture, not just like a check, are we remote or not? Like, it's a core thing to who you are.
I'm still seeing the full span. So we have some companies that remained in person to the extent that they could, or never fully adopted the virtual first. Almost all the companies are doing some kind of hybrid right now, and some are expressly virtual. I will say maybe it's because it's end of quarter, end of year. There's a lot of offsites and retreats happening right now for all of the employees that are remote to come together over a 2 or 3 day period and do all sorts of company planning, culture planning, goals and vision, and the energy level is like through the ceiling. And so I think the big challenge as a leader is, how do you hold on to that incredible excitement that happens during those offsites and maintain it when everyone goes apart and comes back together again later?
I think we drew some false conclusions during COVID about remote work, how easy it was. And it's maybe not surprising in hindsight, because we did a lift and shift of an existing team that had existing communication channels, trust, relationships, and everybody decided to just do Slack and Zoom and work from home. And it worked really well. And it was like, wow, this is easy. And it just kind of became conventional wisdom that this is how every company was going to get built. And now fast forward, almost 3 years now, and I've actually pivoted almost the opposite direction. And I don't think remote work or hybrid work is particularly effective for most of the companies that I see.
Is this just because the West Seattle Bridge opened again?
I have been getting downtown every day. 3 years of isolation will do that to you. That is true. But remember, if we were having this conversation in 2019, we would have sat on this panel. We would have said, if we would have been talking about remote work, we would have said, yep, it's a corner case, but you want to be on the barbell. You want to be all in person because that's how you set culture, or you want to be super intentional and you want to do remote only. But don't be in the middle. That's where all the problems happen. And now everybody says, well, we're all hybrid. And we're asking people to come in 3 days a week, but they don't really. And we don't really have a mechanism. We don't want to force them to do so. And it's causing real problems in companies. And so I think that we're right now starting to recognize, oh, this is not a universal positive. It might be a universal positive for employees, but it is causing problems with a lot of companies because they weren't intentional about their culture. And they're not recognizing that, oh, this works really well for the enterprise salespeople. But you know what it doesn't work really well for? The inside salespeople who make 160 or make 120 OTE, and they're fighting for space at their kitchen table with their roommates trying to make inside sales calls. It's really bad for those people. They need mentorship. Imagine being a college graduate. And your first job, you're now, still living with your friends and trying to do deep work. It's nearly impossible. And I think we're just now starting to recognize that. So in summary, I think we need to get back into the office. We probably won't go all the way back to what it was, but 4 days a week is probably the ideal scenario for most companies with exceptional, access to talent as exceptions rather than the rule.
Yeah, I think that summed it up. I mean, at Fuse, we're in the office every day. And part of that, too, is when we're getting, the fund off the ground, it really helped with speed and decision-making and, learning and having those conversations, and certainly with leadership and mentorship exposure there. But yeah, I mean, I think it's obviously a complex subject, but I don't think flexible work is going anywhere. I'm a firm believer in get your work done and whatever that looks like. So, I personally, really enjoy the in-person experience. But, being able to, life happens, and if you need to go take care of your kids and then hop back on later at night. So I don't think this notion of flexible versus just your butt's in your seat from 7 to 6 or whatever it might be. I think that paradigm has changed. But agree that it's complex and dependent on teams, companies, the person themselves.
Do want to open it up for any questions that y'all might have.
I'll take this one. You can yell too, but you can do this.
Yeah, I'll ask a question if you guys don't laugh me out of the room. Okay. Nobody's talked about crypto or Web3 or blockchain. Now, I know crypto is a no-no, but do you guys have an investment thesis around blockchain and or Web3? How are you guys thinking about that?
I'm a 3 for 3, and I just don't want to bat again.
When you see VCs start to pump out content marketing around a given topic, that probably means it's time to go the opposite direction. So just be careful. Look, it's funny because if we would have done this a year ago, we would have had to have spent probably half of the panel discussing it. And I think to some extent, we never really got into the is Gen AI overhyped. I don't feel like we actually double clicked on that. But I think you can view those in a similar way to one of Aviel's comments about this is a tool, and it's unclear if we can find a good use for the tool. But what is interesting is people who are actually driving value to customers, and that has always been the missing piece within whatever euphemism you want to work for anything that is built on a blockchain. At this point, I'm losing the ability to keep saying, well, we're early because of how long ago Satoshi's white paper was actually published. I can't intellectually say that anymore. And so I keep looking for the right intersection of team and people who are actually caring about delivering value to customers, however they're defining customers. And at this point, there's just so much mistrust in the space and the intentions of the people who are building there that it's really soured, I think, a lot of the people that are on this panel. I guess I'll only speak for myself.
Yeah, it was funny. I think when you said crypto, I think I saw like 5 people in the audience just shudder.
Doesn't mean it's not a good time to be investing in the infra side of it that has wider applicability, but everything else.
Any other questions?
Since this big reset, as we want to call it, has your evaluation criteria, or how has your evaluation criteria changed when it comes to determining whether to invest or not? And like, for example, let's say you might have had a checklist of like 10 items, and if all the 10 were checked, it was a go. Has that changed to like say 15 items or 20 items, or necessarily like what would be some specific characteristics, some specific additional characteristics you might be looking for before making a decision to invest?
Making a lot of assumptions about diligence here. We just didn't do that for a few years. I'll answer the question slightly different from my perspective because I think it's fascinating. Is like mostly we were just price takers for a while, so it's less about diligence and more taking price. And we just had a situation where we're like, we want to do this, but you proposed 20, and we feel like 10 is right and in fact generous. Like, okay, we'll talk again. It's like we talked and we decided that we would do this at 15, and we're like, okay, it's still 10. Like, okay, we'll talk tomorrow. Like, it's 13 now. And we're like, it's still 10. And they're like, we'll take 10. And I absolutely would not have been able to do that before. And I think there's a mixture of the confidence of like knowing that you're not just going to lose the deal, and you can actually hold a harder line in terms of what you think a fair price is. And that's just something that we were not capable of doing because there was enough done money out there where you just had to be like, do I want to do this deal or not? Well, I just take the price. So it's less about, I'd say, the diligence checklist as much as it is just like, turns out software companies are worth a lot more than we thought, and so I shouldn't grind on price.
Over the past, I'll call it like month or two, I'm still seeing a number of companies, let's call it at the Series A, that have incredible growth numbers. So there are still ideas and great companies being built that are able to sell right now. So that's really exciting. On the flip side, and we all have these companies in our portfolio, you raised either at a high valuation or, it's unfortunate timing in your cash runway cycle that you're out of cash first half of this year. And you know that there's going to be a valuation reset or that you haven't hit your metrics for maybe a combination of reasons, right? Macro has changed, you haven't hit some of your revenue goals. And so what's interesting and what's happening at the boardroom level is to what extent, from a capacity perspective and from an interest and engagement perspective, do your existing investors, are they able to and willing to kind of back up the truck, so to speak, and do an inside-led round? Or do some sort of bridge round to get you a little bit more runway so that hopefully you can prove something out that everyone believes you're just on the verge of proving out. You just don't quite at the moment have enough runway to get there for when you would normally need to fundraise. So there's a couple ways to look at it. One is if you see companies going to market that have those kind of investors and maybe they're orphaned, right, because they haven't hit certain growth thresholds, that's a difficult position to be in. And I had one more point and I'm missing it. Do you have another one and it'll come back to me?
I mean, where my head went in that because you were talking about people, would they do the inside round or other stuff? One thing that we're seeing right now with investors too is that, do you have it back? I'm done.
I have it back. Thank you for that. You helped me riff. On that inside round led point, a popular phrase is you don't want it to be a bridge to nowhere. So if your insiders, your existing board or your existing investors say, hey, okay, we can, I don't know, make up a scenario. We can all pool together and give you an additional $3 million or an additional $4 million. And that gains you, depending on your burn, let's say 6 months of additional runway. Well, where will you be in 6 months? If you still can't hit certain milestones that outside investors are looking for, then what's the point? And so there's a lot of like hard discussions on where do we need to get, how do we get there, how do we reduce burn in the meantime so that we can extend our runway and make more progress without having to come up against these critically difficult decisions for business survival.
Go over there to Ganesh.
Well, thank you all. I appreciated everybody's input, and it was music to my ears to see an affirmation of life sciences as a choice for many of these others. Now, Aviel, that includes you too. Farming is the core life. But I do come to these meetings because, I've been tainted, maybe not tinged by Microsoft, having worked there, so I do enjoy them. My question for you is kind of related to what you referred to in a comment to the crypto. If you were sitting 8 months ago here, what would you, I know hindsight is 2020, but what would you advise as caution that you were seeing 8 months ago that may have led to where we are now? I do understand it's a roller coaster, and sometimes till you're there, you don't know you're going to go down, but you guys may see certain things, and I wonder if there's some advice you can share.
I think James alluded to it, and I'll say it a different way, is the people. Like, I mean, you're talking about it when you see the content marketing budget, but it's the people. When you see, like, the worst people you've ever worked with in your career, some of whom you're like, fuck, that's an actual sociopath. Like, and they're just all doing the same thing. What else, even if I have nothing else to say. Like, just, would you walk in, if you saw everyone that you hated walk into a bar, would you be like, I should go in that bar, it's popular?
Yeah, my comment relates to that. I think going back, we had a couple of scenarios where, it's worked out, but it's like, you would have learned so much more from meeting that person in person. So I feel like we've really indexed back to that, especially with founders that, like, before we make an investment, meet them in person. So I think that there's just so many more learnings that you can have from that interaction.
Last question over here.
You all spoke about starting as entrepreneurs if you're really passionate about it. But I'm curious, as investors, what are the specific traits do you look at when looking at a deal to identify the passion of the founding team or the founder?
Didn't we cover this in class? I believe we covered this in class, but we can cover it again. He was in my UW class. I think that this is a big piece of this is, as Sarah just said, like spending time with these people, and that's one of the reasons, again, like why companies get orphaned, because it's not based on a real relationship. Investing in companies is giving someone a commodity. $1 is going to be the same regardless of which of the four of us wrote that check. But we're all going to have a chance to develop a relationship with a founder. And so, when she was talking about competing on deals or being in competitive situations, it shouldn't be just pulling the price lever and moving things up and up and up. It should be about establishing value and demonstrating why you would want to share success with me instead of one of my peers in the industry. And so the more time that you spend establishing that relationship, you see who's genuine in their mission to change an industry that they're going after, and whether they have founder market fit, which I know we covered in session 2 of class. You pick those things up the more time that you spend with those teams.
The other thing I'll add too is what can come across in a founder's language is their true customer obsession. A lot of times you'll see, oh my gosh, I have this great idea for a product, but building a product before you have the story for the customer about why it should actually exist. So that's just one specific nuance for how are you articulating that in your pitch in the product, and always coming back to that.
Wait, we're good.
All right, well, we'll stick around for a little bit after, but thank you to our panelists. It was fantastic.